Okay, we'd like to welcome everybody to the webinar today. My name is Rob Burden, and I am the Vice President of Sales with Paramount Property Tax Appeal, and I'll be your presenter today. We also have Tom Bergeson, who will be answering technical questions for us at the end of the webinar. Just to give you a little bit of background on both Tom and I spent the first 7 years of my career with the Big Four public accounting firm known as PricewaterhouseCoopers. After a 7-year stint there, I moved on and was controller of an international manufacturing company. Since that time, I have done a little bit of real estate and done a number of other valuation issues, which kind of gives me my background in the property tax arena. Tom Bergeson, prior to joining Paramount Property Tax Appeal, was with the San Diego County Assessor's Office for 27 plus years and was a senior supervising assessor prior to seeing the light at the end of the tunnel and coming over from the dark side, as we like to say. And again, Tom is our chief technical guru when it comes to understanding business property tax statements and the liabilities and what you can do to reduce those liabilities. And Tom is on the call and will be available to answer questions at the end of the call. Today's call, we're going to keep all of you muted because we have quite a few people on the line here, and we do want to cut down on some of the background noise. If you do want to answer a question, please feel free to go ahead and type your question in. Our moderator, Keith Jenkins, will be tracking those questions and will bring a number of them to the forefront in our Q&A session at the end of this webinar. So let's get started today. Again, we're going to go through this. I'm going to try and get it all done in a span of about a half an hour, including the Q&A, but we will stick around as long as possible to answer any questions that you might have. Okay, so topic of today's webinar is why you are overpaying your business property tax. We're going to take a look at what a 571L is, what your business property statement is, and how it is taxed, and why you could be overpaying. Okay, what is a Form 571L? The 571L is your business property tax statement. Each year, every company in California is required to file this statement for every distinct physical business location, i.e., if you have 5 separate locations in California, you have to file 5 separate returns. There are no filing consolidated returns like you might do on your state income taxes or you can do on your federal income taxes. A company must declare on the statement on all non-real personal property, assets that are used in conducting its business and that are not for resale. Essentially, your company's property and equipment. You're not going to include anything on there such as your inventory or anything else, or any real property such as the building, the walls, that type of thing. But any of your property, plant, and equipment, anything used in the manufacturing process, be it your machinery that used in the manufacturing process, all of your computer systems, your desks, your chairs, anything else that's used in the operation of your business. One last thing, and I will put down there, it does not include automobiles that are registered with the Department of Motor Vehicles. Okay, now, these assets, in a normal course of business, when you put them on your books, you go ahead and you determine the useful life, and you then pick a depreciation method for which to write those off. That's the GAAP matching principle. We're going to talk a little bit later about that. But these assets are assigned a declining value each year based on the assessor's definition of useful life, not your definition of what the useful life, what they determine to be the useful life. And as we get into this, why we're overpaying on business property tax, you're going to see that this kind of becomes a key point to all of this, is that this is a very archaic and transparent process that the assessor uses to determine the value or the assessed value of your business property of your business property assets, and thus the tax that you pay on those. So each year you fill out a Form 571L. It's a standard business property statement that I think probably everybody on this call has seen. You report on there all of your equipment. You put it into furniture and fixtures, computers, whatever it might be. And then you send that in. And then the assessor goes ahead, and the assessor does a lot of things that are behind the scenes to determine what your value is. You know, when you fill out your financial statements, you go through and you have access to all of your PP&E records. You can see what the depreciation is. You know whether it's right or whether it's wrong. Even when you go to do your tax returns, you know, the IRS has makers, acres, all of that stuff. You're the one that's responsible. Your company is the one that's responsible for actually determining what the actual depreciation or write-off of those amounts are each and every year, and you can tell whether they're right or whether they're wrong or whether they're misclassified or they're not. You send in total what your property values are, and the assessor does it for you. They come up with an assessor. I mean, they come up with an assessed value, and it says once an assessed value is determined by your respective county assessor, a tax rate is applied, and this determines the amount of business property taxes that you pay each year. The business property tax isn't real sexy, it isn't real big, but it is something that you're overpaying every year. The base rate that you're going to pay is you're going to pay an assessed value of 1% plus any voter mandated additional taxes for sewer districts and things like that. While the number changes every year, you're going to be looking at paying about 1.11% of the assessor's value. So if you have $10 million in equipment on your books, excuse me, if you have $10 million in equipment on your books, you're looking at paying about $110,000 a year in property taxes, business property taxes. Okay. Why are you being overassessed? Well, we feel that they're misclassifying a lot of these things. There's a lot of things that we're going to get into, but in our opinion, the 30-plus assessors' offices in California applies a one-size-fits-all approach to all businesses in California. As we talked about a minute ago, when determining the useful life of business assets, the assessor uses broad-based categories with long lives without any regard to the nature of your business. As I look through the attendee list here, we have a number of different people from different type businesses that have different type models. If you are in the high-tech or the biotech arena, you'll find that you are buying and purchasing a lot of things that pretty much their useful life is going to be done in under 4 or 5 years at the most. Well, when you put those into furniture and fixtures, while that might be the complete useful life for that, the assessor is going to look at those as a 12-plus year life, maybe even longer. So what that ends up meaning on your financial statements, you look down and those assets are written off, and at the end of 4 years you look at your balance sheet and net is zero, and there's no P&L hit, there's no balance sheet hit because it's net. Again, the accumulated depreciation is the same as the cost of the asset, and there's no balance sheet hit to it, and once it's fully depreciated, there's no P&L hit to it. With the assessor's case is if you keep those on the books and for whatever reason you don't take them off, you're going to continue to pay taxes on those over the entire life until you either sell the asset or write it off or whatever it is that you do, but you're going to pay those at much higher rates. Then GAAP versus property tax. Under GAAP, again, we went through this. Okay, we've already talked about that. 4-year life, it means you'll be paying business property tax. I got to fix that for useful life. Okay. Okay, I got to get better at that. So what does here's what an example of $1 million in machinery and equipment that is misclassified by the assessor's office would mean to your company over the life of the asset. And we're going to change over from this, and we're going to go to okay, again, as we explained earlier, when the assessor, if you have $1 million in machinery and equipment that you bought in 2012, if it's classified as machinery and equipment, the assessor is going to take and it's going to tax you on that amount over 12 years. Not on the full amount that you get, but on a declining value. So if you'll look down here, and in the first year of having $1 million, you're going to pay on what they call the FCV, or full cost value. And that's a percentage. So if you have $1 million of equipment in the first year, they're going to tax you on 91% of that, or $910,000 if you apply the tax rate. In the first year, you're going to turn around and you're going to pay over $10,000 a year in personal property taxes on that $1 million in machinery and equipment. If you look down and so as you can see, there's a declining scale that goes from 91 to 83 to 76 to 68. And at the end of 4 years, you're still paying on that machinery and equipment to the tune of 59% of its value, or $590,000. Again, in year 4, you're going to be paying still $6,500 a year for that. A cumulative amount on this over those first 4 years is $41,847. Now, if it was correctly classified as it should, excuse me, in a 4-year life, if you look down and we have the same machinery in the first year, we're not going to be paying at 91%, we're going to be paying at 75%. So in the first year, our total tax is only $83.25. And instead of up here in year 2 of paying at 83, you're going to be paying down here at 53%, and you can see how rapidly this depreciates. So come the end of the 4th year, you're only paying a tax rate on the assessed value of 9% of that $1 million. So instead of paying, in year 4, instead of paying $6,500 as we are with a 12-year life, we're now paying $999. So if we'd have written that off and properly classified that to the tune of a 4-year life, the total that we would have paid for the first 4 years is $20,868. So just by performing a simple reclassification, we're going to save the difference between the $41,847 and the $20,868, and we're going to make that a 4-year savings, excuse me, of almost $20,000. Now, if you imagine that you did this and you had $10 million in property and equipment, and it was misclassified and it was paid and was kept on the books for over 12 years or sometimes longer, you can imagine that number goes up appreciably, and you're looking at paying almost an additional $200,000 in property taxes. And this isn't a timing thing. This is the amount of money that you're going to pay over a period of time. And a lot of times people say, well, Rob, I'm going to get rid of the stuff. I'm not going to keep it on my books. That's great. So even during those 4 years, do you want to pay an additional $20,000? No. Additionally, what happens is in a lot of cases we get companies, property, plant, and equipment is a pretty straightforward, pretty easy thing to take care of on your books. You put it on there, you depreciate it, you make once a month journal entry to it. But the reality of it is that there's a lot of other things going on in your business that are tugging for your time. Unless a piece of machinery is, is either sold and there's cash that came in the door, or it's physically you tear down a plant or something like that. The reality of the matter is, folks, is that a lot of time fully depreciated assets that probably aren't used in your business anymore are kept on your books. I'm not saying that everybody on this call doesn't have squeaky clean property and equipment, but the reality of it is some stuff will sit out there even after it's long since been depreciated. And we've seen it time and time again. We did some work for a current client, and the first time we looked at their records, we started examining stuff, and we realized that they were a high-tech manufacturing company, and they had $6.5 million in assets that were purchased before 1994. That's almost 20 years old. And as we dug in further, we looked down, and they had about $100,000 in typewriters, physical typewriters. And we're in 2013, and as we walked around their plant, I kept looking for typewriters all over the place. Well, I couldn't find a typewriter in there. The point is that they had been put in this, a 12-year life category, and then they just hadn't written them off. So over 20 years, were they down, and were they paying around 10% on them? Yeah, they were paying around 10, 11% on them. But the point is they've been paying that for almost 20 Make sure that I don't unplug my speakers accidentally like I just did. So the point is, again, going back to their definition of assessed value, the assessed value you don't get to see these tables. You report one amount in total, and they put them into which categories. Now, if you can do some digging and do a number of different other things, you can go back and you can find these, but most people don't even know where to go to find these. And the assessor is determining what's useful life in your property. Nobody knows your business better than you do. And for someone to look at a form and reclassify everything without having any idea of what's going on in your business is archaic, asinine, and in a lot of cases is very non-transparent. So that's where the big numbers come out. I'm going to erase all the drawings here on this, and I'm going to go back to my normal drawing mode, and we're going to get back to where we are. Okay, again, now we've talked about the classification of assets and how everything works along. There are some other reasons for overassessment. Other reasons for overassessment, and there's a number of different reasons. Ghost assets. Ghost assets, again, we talked a little bit about that, are assets that are sitting on your books that are fully depreciated. They have no P&L impact. They have no balance sheet impact. But for whatever reason, you just haven't gotten around to doing a physical inventory and making sure things that are there, you know, tools and dies and stuff that runs out of useful life, and the reality of it is it's either thrown away or thrown out the back door. We find a great deal of companies have a great deal of ghost assets. There are certain industry exemptions, and they go across the board, and we're just picking out a couple of them because everybody on this call right now is in a different industry. I'm not going to try and go through all of them, but just to point out a couple, the movie industry has unbelievable exemptions that people don't understand and don't know to report on their 571L. They just report their property and equipment, as it says within the one-size-fits-all instructions, when in reality they shouldn't be paying on about 90% of their property and equipment, but that's just for the movie industry. I don't know if we have anybody on this call that's in the wine industry, but there's a great deal of exemptions for the wine industry. We can go on and on. Solar has its own exemptions and a number of things like that. We have certain asset classification exemptions. Capitalized software and solar are just to name a few. So, okay, we figured out why we're being overassessed, and hopefully I've shown that why we're being overassessed. So now you've looked down and probably a light switch has gone off in your head going, okay, well, what can I do about it? You know, if the IRS sends me a bill, I got to pay it, or I got to pay somebody to fight it, or if it's it's an audit I'm going through, at least I can, talk to my auditors about it before I have to pay a big bill. You've got a couple different options. Each year, every taxpayer has the right to appeal before the County Appeals Board the assessed value of their business property. And we encourage everybody, if you think you're being overassessed, we encourage everybody to do this. It really isn't a huge time-consuming thing on your part. The time-consuming thing would be actually going back through and, understanding how they do everything, understanding how they classify things, understanding how you turn around and go, okay, well, we think this is wrong. But it really is not the biggest of labor-intensive process. The thing about it is that appeals can take 18 to 24 months to complete. Generally, your case will be heard if you couldn't settle it beforehand. Somewhere in that 18 to 24 months, by law, they have to hear your case. The County Appeals Board has to hear your case within 24 months. So it does take a lot of time. Just so you know, depending upon your county, the dates to file an appeal run from July 1st to November 30th. Certain counties have a September 15th deadline. There are 32-plus counties in California, depending upon where you're in. If you give me a call or shoot me an email, I can clarify when they are. I don't want to try and list them all out here for you. That's the number one thing you can do about being overassessed, is appeal through the county assessor's office on a yearly basis. The second thing is every company in California with an assessed value on their business property in excess of $1 million is subject to an audit every 4 years of the Form 571Ls they have filed for those periods. And the periods run from the 1st of January through December 31st. So if you are in excess of $1 million in business property equipment, excuse me, and you haven't been audited in the last 4 years, odds are that you're going to find out in about pretty soon you're going to have the county assessor knocking on your door. No one likes audits. They're a pain. They scare the heck out of everyone. Audits just have a bad connotation all the way around. We don't always look at that in that case, because what ends up happening, well, you can go back in and appeal on a yearly basis the amounts for 2012. An audit will open up the previous 4 years. So they're going to go back and look at the previous 4 years. Now, to the extent that we can identify mistakes or things that should have been classified differently, or we can identify ghost assets, we can assist you in actually reducing those assessed values during those years and actually obtaining a refund for the amount of business property taxes, the actual check that you wrote to your county assessors. We can actually go back and get you refunds for all 4 of those years. Now, I don't want to say anything negative about our respective county assessor's office, but I will tell you that they're really looking for compliance. They're not going to come in and say, oh, by the way, Mr. Biotech Company, I realized that you bought $10 million worth of equipment to do a phase 1 drug trial, and I realize that it's only going to have a useful life of 4 years, but the reality of it is it's in furniture and fixtures, which is out over 12 years. The odds are they're probably not going to go back in and correct and go, you really should do this. They're looking for compliance. They're looking to make sure you capitalized everything. They're making sure that you're not expensing things. So the reality of the situation is, well, I can't say that it's never happened. The reality of the situation is they're probably going to make, if they don't see anything wrong, they'll make no change or they'll increase the assessed value on it. They're not going to go back, and while their job technically by law is to assess a correct value, they're looking for compliance. They're really looking for compliance, and that's kind of where we come in and have had some significant success in helping our clients going back and recorrecting and refiguring out excuse me, on a yearly basis what the true full cash value of that should be and what you should be paying taxes on, and knocking those amounts way down. So if you do come under audit, it's a great time. It doesn't take 18 to 24 months. You can actually go back a period of 4 years and obtain physical refunds for that. So in terms of an audit, I understand everybody doesn't want to deal with an audit. It's a pain in the backside, but it is something that can be good for your business. And I don't know very many other audits. I've been through financial statement auditors by our outside auditors. I've been through sales tax audits. I've been through IRS audits. None of them were going to provide me any benefit along the way. This is the only thing that I know about that can actually put money back in your pocket. So, with that being said, that's the basic overview of where we are. And there we go. Got to the right slide. Again, I wanted to keep this at a 30,000 foot level because we've got a lot of different people on the line, and every business model is different. Our business is built on helping people, helping companies like that understand the complexities and getting through the lack of transparency in this. Tom here is our technical guru. Again, after spending 27 years there, he knows the ins and the outs of the county assessor's office across all of California, knows where things should be, understands the code, and is now working on the other side. And that's where our business is built, is helping companies. And we are in a niche market, to be honest with you, and it's one that not a whole lot of people know that much about. I know when I was a controller, if you'd have said something to me about it, I would have just filled out the form. I was going to go focus on what was my IRS problems, what was my franchise tax board problems. That got a lot more in terms of play, because the reality of it is it's a bigger number. But the reality it looks down is goes, if you have somewhere between $4 million and $10 million or even more, there's an opportunity for you to save quite a bit of money. And if you could turn around and you could save $20,000 to $40,000 per year, that's going to place another productive employee that you can put on your payroll and move your company forward. So, for further information on the Form 571Ls, we're going to take some questions here in a minute, and how you can avoid overpaying your business property tax. Again, please, this is my contact information. It's Rob Burden at Paramount Property Tax Appeal. There's my email address, and if you'd write that down, it's r.burden r.burden@pptaxappeal.com. It's r.burden@pptaxappeal.com. Our phone number is 858-225-1200. At this point in time, we're going to open it up for questions. And again, we've been at this now for about 20 minutes or so. So again, I'm going to try and take questions for about hopefully for another 8 to 10 minutes. At that point in time, folks, feel free to drop off, but we will stick around and answer as many questions as you can. So the first question up is from our moderator, Keith Jenkins. Keith, go ahead. That's a great question, and now I'm going to let Tom Bergeson, our technical expert, answer that question for you. So we go on with Q&A, and we do this for about 5 minutes. So we're going to